Okay, cool. So, well, thanks for having us, by the way. The presentation is Effective Financial Integration in IBP Processes. And I'm going to let Richard introduce himself, and then I'll do likewise. So, Richard, why don't you say a couple of words?
Yep. Hi. I'd like to thank everybody for taking the time to listen to Dean and I. Thank you for the opportunity. My background, I've been in advanced sales and operations planning, what's now called integrated business planning, for about 35, 40 years now. Started back in the 1980s. You can see on my professional there, a lot of global companies, and you see I've listed out ops planning, sales and operations planning. I've also been a consultant in focused in the integrated business planning area. My background, my skill set, advanced S&OP, demand management, master production scheduling. That's me. I'll let Dean, you want to describe yourself?
Sure. For me, I've been in the professional world my entire career. Started off in public accounting, and then I've worked for some of the major consulting firms. I would really call myself an expert in sort of integrated planning and performance management from both a financial and operational perspective. And, you know, those integrated processes really help organizations optimize profits and cost structures. So that's really what I would call myself, an expert in kind of something kind of broader than just IBP. Having said that, a lot of my experiences gained from, you know, the experience I've had with clients. Obviously, there's been over 100 manufacturers that I've worked with, but there's kind of three things that have really kind of helped shape my thinking on integrated planning and performance management. So first of all, I was one of the original authors of the integrated performance management methodology for Accenture. And I actually worked for a prescriptive analytics software company. And it was, I don't know if I call it a supply chain optimization, but what they were really doing is taking kind of supply chain or network modeling to sort of a different level. And that really kind of changed my thinking about what advanced planning really was from both a financial and operational perspective. And then, well, 4 or 5 years ago, I was actually contracted by a financial planning software company to develop an IBP solution for them. So, you know, the net of all this, I have a pretty deep understanding of the process from both a financial and operational perspective. And I also have a pretty deep understanding of both the FP&A and S&OP software market. So, you know, I'm kind of what we're going to be talking about is rooted in some reality. So I think when you read the invitation for this, you probably saw that we were going to answer the questions shown on the screen. Really, what do you mean? Essentially, what we're doing is answering the question, well, what does financial and operational integration really entail? But the one that's identified really at the bottom as well, which is going to be important for you individually, is how will these integrated processes benefit me personally? Because the processes will address issues that are important to companies, but they also provide opportunities for professionals. And I'd say that Richard is probably a pretty good example of that, because he's actually one of the more forward-thinking, IBP practitioners that I've run across. And if you he'll describe his role, but he's in a very unique role, which I think you should find terribly interesting and be something that I think a lot of people should aspire to have a role like that one. So you'd be interested to hear from him about it. So when we get through this webinar, you should probably have an idea of what do we mean by fully integrated process? What's new about what we're talking about, and also have an understanding of what the processes could be worth and the challenges that they address from both a financial and operational perspective. So I'm not going to spend a lot of time on this, but one of the things I do, I actually volunteer for Foresight Magazine. I'm their IBP editor. I wrote an article a couple of years back entitled Strategic IBP. If you want a copy of it, drop me a line. I'll send you a copy of it. But really, this whole idea of strategic IBP, I've defined it there, and I'll define it in here as well, but that's kind of where it came from. As well, I've got on my website, if you're interested, there's a whole bunch of videos on there. There's articles as well. So anything we miss is probably, or you want to see in more details, probably covered in these videos. So in terms of an agenda, this is really what I had in mind. First, what we'll do is have Richard talk about integrated business planning, kind of the scope of what he's doing and some of the objectives he's trying to achieve in his current position. Because I think that, what he's doing, and like I say, in his role, is really, to me, the epitome of financial and operational integration. So this is kind of real world stuff, doing some pretty pioneering things. Then I'm going to provide like a case study that really frames the problem or challenge of integration, the problems that it solves. Then I'll give you an overview of my perspectives on the current state of financial and operational integration. Then talk about the critical capabilities that you need to really enable it, and the ones that companies really struggle the most to implement. Then we'll talk about a strategic IBP process and its integration with finance. So, how does the traditional 5-step process that we all know, how does that reconcile with a more mature one that includes finance? Then Richard's going to talk about the integration of strategic IBP and advanced production planning and scheduling. This is a really key part here, because this is kind of the guts of what a lot of companies struggle with. And he's doing some pretty interesting things, and he's got some interesting thoughts on this. Then I'm going to circle back and talk about some insights for finance. So one of the things that we're thinking about is that if you're thinking about having greater some integration with finance, either integrating a rolling forecast with S&OP, what could you share with your finance colleagues? So you want to be able to make this video available to them. So what is it that we're going to say to them that's going to be relevant to them, and help them understand what the opportunity is? And I'll be kind of identifying some of that as we go through, but I'll also kind of devote a section to it. Then we'll talk a little bit about technology and what's enabling the processes and what enables mature forms of integration. And by the way, we're not going to be talking about any specific applications. This is all going to be just very, vendor agnostic, but just talk about, what's out there beyond, things that you may already know about. And then Richard's going to wrap that up with some kind of parting thoughts about his perspectives about opportunities for supply chain professionals, and then we'll open it up to questions. So that's the agenda. Hope that meets your needs, and let's just dive in. So I'm going to turn it over to Richard, and he can provide some background about what he's up to.
Okay, Dean, if you're going to run the slides, if you can see me, I'll do a thumbs up to move to the next slide. That works for you? Okay. Yeah. So again, I'm Richard Herman. I joined Geon about 2 months ago after leading Eastman Chemical's IBP Center of Excellence for the last 5 years. Okay. what does Geon do, right? Geon's a leader in PVC and polyolefins compounding, right? It's a relatively new company, created about 2 years ago. And this company's got a very aggressive growth strategy, right? Our products are compounds you'll find in automobiles, wire and cable, moldings, and other specialty plastics, right? Our objective, our objective is growth, and we're going to hit this growth through growth in our current growth of market share in our current markets. We're looking at capturing new markets out there. And more importantly is growth and profitability through reduction of our overall supply chain costs, right? Maximizing our value to our customers and actually minimizing our cost to deliver to those customers. Okay. My role, okay, I am the Director of Integrated Business Planning. It's a new title. I had to convince the company about integrated business planning. Everybody wants to call it sales and inventory optimization planning, SIOP. There's a lot of people call it S&OP. Dean's going to really get into this, but the big difference, we're kind of pushing the IBP mentality. Well, okay, sales and operations planning has a history of pretty heavy focus on supply chain, on balancing the supply chain. What IBP adds to this is, well, finance and strategy, aligning all that together, right? What's really exciting me about this role with Geon is the IBP initiative is being led by the CFO, and this is new to me, right? This is something in the past. It's always been a supply chain kind of push to get the S&OP in, but with Geon, it's very focused. The CFO and the CEO of the company are who I'm going to report to, right? Our objective, they've stated to me, is look, implement a strategic IBP process that enables the company to succeed. Doing the three things you see listed here, right? Enabling the company to increase demand and manage increasing demand and complexity, profitably capitalize on our short-term opportunities. Everybody's living through COVID, right? COVID, we're all living through the supply chain issues across the globe. There's all kinds of short-term opportunities to recover this, right? We're trying to look at a longer term. How do we get to IBP? But also, look, how do we, if we're going to build a long-term IBP strategy, how are we going to use that IBP process to get us out of the firefighting we're in today? Okay. So I stress we're focusing on delivering a strategic IBP as opposed to a tactical IBP, right? Dean's going to get into the details of the differences between strategic and tactical, but at a high level, we want to go beyond, what we want to do is go beyond simple volume balancing of supply and demand to having a process that allows us to automatically flex our cost structures, to optimize profit, and ultimately a process where cash flow and value are the direct outputs of each IBP cycle. Okay, difference between IBP and finance, right? Strategic IBP means that we have fully integrated these two blocks you see here, right? One block is the IBP process. The other block we're calling rolling forecast. Well, that's the financial output. Okay. Strategic IBP means we fully integrated these two things, right? The Geon has this discussion, this is why I'm at Geon. Geon is kind of realized this and saying, well, wait a minute, I've got to have one integrated plan, right? How are we gonna bridge the gap between integrated business planning and the financial rolling forecast? Well, scenario planning capabilities simultaneously evaluate financial and operational objectives while respecting the value chain constraints. That's the key focus of the integration. If I can build a planning model that describes the movement, the storage, the transformation of products, that model should also be able to simulate the movement of cash, right? I should not have a different operational and a financial model in a fully integrated process going forward. These two black boxes you see here, well, I should, successful IBP is I've got these two black boxes integrated into one box. Dean, I'm trying to get my my thumb up in the screen for you. All right. Give me just a second. So immediate focus will be on developing what we're calling API, Advanced Planning and Scheduling capabilities, right? Advanced planning and scheduling tools, these are the plugin applications that will enable this integration. These tools are comparatively new, and over the last couple of years, they've become increasingly powerful, right? And Dean's going to talk more about these later in the presentation, but advanced planning tools are how we're going to bridge this gap. The next one. Okay. In my past, right, automatically reconciling and aligning our mid-term to long-term plans with our near-term execution has been a major gap. It's been a gap over my 30 some odd years in S&OP, right? Operations didn't trust the plans because the plans didn't resemble what was actually happening in the near term. And what was happening in the near term very seldom was reflected in the replanning process for the mid to the longer term horizon, right? We often had multiple plans, and these multiple plans reinforced silo management, resulted in a heck of a lot of firefighting when it came to time to close the gap between reality, what was happening on the ground, and what our financial targets were, right? It's these APS tools that are going to allow us now to automatically reconcile and align our monthly planning process with our near-term organizational execution. Okay. This is what we mean by advanced planning systems. Okay. APS tools that allow us to deal with uncertainty and ambiguity. Instead of a one-number plan that we know is going to be wrong 100% of the time, we can build, if you live in an ERP world, well, ERPs don't deal with ambiguity and complexity. It's a one-number planning system, right? But that plan is always wrong. What's important is how wrong, right? Using these APS tools, we can now build base case, best case, worst case scenarios around headwinds and tailwinds that are going to quantify just how wrong the plan could be. If we know how wrong the plan could be, we can now build contingency plans triggered by key indicators and milestones that are going to allow us to build flexibility in our operations and our marketing strategies. We can right-size our inventories across multiple delivery channels. We can plan for new product introduction without having to completely specify the final product and the customer. We can build demand plans that balance customer needs with our true operational capabilities, right? And we can sense in the near term how demand and supply are executing and automatically rebalance our plans based on disruptions in either demand or supply that happen all the time, right? And the big power of APS is we can do this in real time now going forward. Okay. Now, a little bit more on what excites me about my current role here, right? I've got here last company, and I've got here what's really got me excited about Geon with the strategic IBP versus tactical IBP, right? The difference that got me to jump on board with Geon is it's an opportunity to implement strategic integrated business planning instead of tactical integrated business planning. Be specific about these bullets will show you the differences, right? Financial integration and cash flow are stated as the explicit goal. The output of my IBP process will be a cash flow projection for the next 15 to 24 months, right? It's not anymore. I'm looking at the next 15 to 24 months and I'm balancing supply and demand to make sure I on a volume basis I can cover that. No, I'm balancing my financials. I'm looking at I'm building plans that I can automatically financially value, and I can say, look, here's the cash flow I am generating This is the cash flow I'm going to use to fund my operations. It's the cash flow I'm going to use to reinvest in the business. It's the cash flow I'm going to use to satisfy my stakeholders. Okay. The 5-step process is not the end result. You guys are all familiar with the Ollie White IBP 5-step process, right? It's an interim, right? Dean's going to talk a lot more about this, the 5-step, where there's a couple of steps that are missing, and he's going to go over those in a few minutes here, right? Rolling forecast, S&OP is one process, right? This is it. IBP and finance are going to be fully integrated, and that is the objective of the CFO and the CEO of this company. The executives I'm dealing with, they want to learn how to do IBP right? And change has to be driven from the top. If you don't have the executive buy-in, it's very difficult to push this from the bottom up. This is something I really appreciate with the new executives is they're asking me what they need to learn. Past companies, it was difficult to get senior executives to change. If I couldn't get them to change, well, I'm not going to drive change to the organization. And Dean's going to talk more about some informed technology strategies, right? This is stuff like low code and a few other things that really open up the opportunities going forward. Okay, explain a little more about these informed technology strategies. Right, my past direction has often been to try and build a functionality that we just talked about within our ERP systems. Right, there's a little interest in investing in best-in-breed applications because there's a perceived risks involved in new and unproven technology, right? It's hard to get new technology into a lot of companies. Most companies want to be followers. They say, well, you prove, nothing sells like success. Show me where it succeeded. And there's a perceived complexity of cobbling third-party applications on top of our ERP systems, right? And to be fair, not long ago, these best-of-breed applications really didn't exist, right? The approach was, okay, you're in an SAP environment, you're in an Oracle environment, build out this functionality in those tools, right? The outcome was always the same in the past, right? The cost of the implementation and the total cost of ownership were always much higher than we expected, right? And the time to implement was really long. And ultimately, the results didn't meet our goals. Okay. I'm now in a position, right, where I don't have an existing ERP system. We're a new company, and we're at a point where we're trying to decide: do we carve out of we are the result of divestiture of other companies, and we're at a point where we're making the decision: do we carve out the ERP systems that from those companies and just do a model and move forward with that? We're looking at that and we're going, well, wait a minute, there's all kind of customization, configuration done in these systems. All that customization and configuration has to be unwound, right? We've got to go in and we've got to unravel all that. And looking at that, we're saying, well, wait a minute, that's going to be a huge effort. And is there any value in that effort, right? If you look at your ERP system, in my past, everywhere I've worked with an ERP, a big ERP, less than 10% of the ERP functionality is actually used, right? But we're paying for that ERP, that huge ERP system. One of the things that Dean's going to taught me over the years, and he's going to talk about more here, is, look, if we do this advanced planning, this APS system, right, I can really simplify the requirements I'll need in my ERP. If I can simplify the ERP requirements, it opens up a new world to me of I don't need to build that complexity in the ERP. I now have a lot of new options that could be a lot lower cost and options that can be a lot quicker time to implementation.
Yeah.
Okay.
So if I just a comment before we. Sorry, I've got an echo. I'll try to Richard, could you turn off your microphone for a sec? Or I'm not sure why I'm getting an echo. Anyway, when we were working on this at your last company, one of the things that I saw was that, a practical application of taking some best of breed technology and making the solution, the IBP solution, much simpler. And I think what we're seeing here at your new company is that this is really very applicable, even more applicable at your new company. And it was, the ability to apply that in this new situation is going to be quite interesting to discuss. So with that, I'm just going to quickly walk through a case study that I find really kind of helps people understand what a strategic IBP process is really all about, and kind of simplify some of the basic underlying concepts. And it's really based on a project that I worked on with a company. And this company, they were a publisher of school books. And what had happened is, after they had gone through a budgeting process, 5 months later, they are experiencing significant deterioration in performance, high inventories and stockouts. And we went in there, we were working for the head of supply chain to fix the problem, evaluate their S&OP process, and then as sort of an afterthought, provide our thoughts on whether they should be looking at new ERP systems. So we ended up recovering control, but it still wiped out half their profits for that particular year. And what we came back with and said, look, your planning process is terribly flawed. And one of the implications of this flawed planning process, and it wasn't just the S&OP, it was the financial planning process, that one of the implications was their supply chain planning staff was terribly understaffed, which was a huge surprise to the CFO that he didn't really agree with. And we told him that it was going to get really bad in the future if you didn't invest in the ERP system. So his response was, well, how'd you get to that conclusion? Because that's different than my understanding. So what I'm going to show you is just sort of a very simple application of what the situation was. So if you think about the company is a publisher of school books, and historically in the United States, you have many different states, but in the past, for let's say a history book, for example, every state would buy the same history book. And fast forward, you find that, well, California wants to have its own, like a chapter of its history in the book, and New York does likewise. So now a book is not a book anymore. As well, they're not just selling books, they're selling testing results, teacher's aids, slides, and a whole bunch of other online testing, or digital assets, if you will. So this was a traditional mix of books. So you had sort of A items, which are a high volume, very simple books, to really some of these more complex books or complex items that we're really talking about that had multiple components to them. So if you just do the math about how they looked at these different types of books, that given the numbers here, so for simple books they do 5 reviews a year, but for the more complicated ones, they were doing them almost every week, and the amount of time they spent reviewing these books was really different. So 4 hours per book, and for really complicated ones, and just a little bit of time for simple ones. So if you just do the math, this ends up being 24 people. And this 24 people was basically, what the CFO took as, here's how I'm going to allocate my my budgets to you. Here's the rules I'm going to use for allocating people. So, $500 per book equates to $2.5 million budget. So whenever he's doing a budget, this is what he's got in mind. Of course, what ended up happening was that if you look up here, the mix of books was shifting. And what was happening is that what they really needed was more people to do the work, because they just didn't have enough. And the way that they were doing the work with the people that they had was that they were doing fewer reviews. And it's these fewer reviews that caused them to miss a whole bunch of things. So things were kind of falling between the cracks is really what was happening. And the real thing that kind of got the CFO was what we said, look, if you're really continuing on this path, and if you're really introducing a lot more books, if you don't fix these processes, you're going to be short 100 people. And to which the CFO went, oh my God, I had no idea that this was happening. And of course, the head of supply chain was saying, look, I've been telling you this for years. I've just not been able to articulate it in this way. But this is really what's happening. And I think, Richard, when we did this case study at your last company, one of the things I think we heard was basically this was happening all over the place at that company. Is that right?
Yeah, it was, right? I mean, we kept struggling with decisions made using average cost without realizing the impact the mix had on those decisions, right? A shift towards a mix of products that required more resources, the products that ran much faster and cheaper, would often push us into these death spirals. Not accounting for the mix variation is often the explanation for why we didn't hit our variable margin targets each quarter.
Yeah. So this mix issue, like when people talk about digital transformation, and basically what you're doing is you're talking about, a lot of very tailored services that may have different service requirements. And when you talk about this is a big problem with when people talk about not executing digital strategies, is that they're not really thinking about, well, what's it really take to execute this strategy? And this is really like one of the fundamental problems with digital transformation, why companies don't execute. So there's a few kind of takeaways from this. First of all, complexity, the complexity issue. So what you're finding is that business segments consume resources differently, and these volume and mix changes aren't always seen. Now, if you look at their existing processes and systems, none of them pick this up. Their S&OP system didn't pick it up. The rolling forecast didn't pick it up. Balanced scorecard didn't pick it up. So as well, what's often not, what people don't always think of is that, these tailored processes are typically, the activities and costs for those things are kind of lumped into overhead costs. So they're not really being all that well managed. As well, when you look at, how we kind of quantified, the number of people that they would be short, the numbers that we had in that little spreadsheet I developed really could have told them what the value of the ERP, key component of the value of an ERP investment would have been. And this sort of insight really doesn't find its way into any processes whatsoever. So the whole idea of managing processes and portfolios of processes really is not a core competency of most companies. Now, a couple other things to think of. When you think about financial planning tools, a lot of companies tend to use a lot of averages, which is why the problem ended up happening in the first place. But one of the interesting implications that came out of this thing, so I actually developed a spreadsheet for this executive to use, and the focus of this spreadsheet was really to facilitate the project, but she actually ended up using it to do her financial planning and staff planning. So what actually ended up happening was that she used to spend like upwards of 2 to 3 months, working on the budget process, kind of going back and forth and kind of negotiating for resources. And with this model that we gave her, because it connected volume to people and had explicit assumptions in it, the amount of time she ended up spending on the annual budget went from 2 to 3 months down to 2 to 3 days. And the whole process was based on, tell me how many books you want, tell me the service levels you're looking for, and I'll tell you how many people I need. That fundamentally altered the entire conversation between finance and ops. I mean, there was no more game playing. It was just very explicit. So one of the things that she was able to do was manage the expectations of the CFO about what can I give you given the constraints that you're going to give me. And that is, if you think about, some of the things that a lot of companies struggle with, this whole idea of managing expectations is not something that most companies do well. As well, one of the things that this change did is that she now viewed the target setting and resource allocation process as being a fair one. That's not the case in most organizations. So if you look at budgeting processes, they're just plagued by what I call unwritten rules. So if you look at these examples on here, whenever I'm in a live conference, and I throw these up, most people laugh, which is really indicative of these things are at play at most companies. So, especially like the first one, always under promise and over deliver. So like if you're trying to run a sales and operations planning process, like how effective do you think that process is going to be if people think they got to game the system? So the key implication and insight here is that, when we implement sales and operations planning and you want this to be more of a driver of an effective process, the thing is, what we're really trying to do is connect resources with targets. And if you don't change the budgeting process, it's highly unlikely that you're going to achieve the sorts of things that you're looking for, because the budgeting process tends to drive a lot of really bad behavior. And one of the things I put up here just to drive this home, this whole idea, I talked about managing expectations. I mean, this is really kind of the heart and soul of a lot of digital strategies. And if you look at, how bad companies are doing at it, this whole process I just described to you about how you manage expectations internally does a lot to help you manage expectations externally. And so I just put this page up just to illustrate something, because I'm going to come back to it in a little while and show you how everything fits. But basically what I'm showing here, like if I took all the things that I did in this one project and put them in a system, this is what it would look like. So what it's doing is reconciling financial plan to activity costs. It's facilitating productivity planning and exposing an assumption. And this is kind of what is driving the cycle time reduction. So this very simple concept I just talked to you about, I'm going to come back to it, and because with this kind of foundational knowledge, you'll understand how we're kind of simplifying the process later on. So I'm just going to skip into the current state discussion of integrated planning, and I'm going to quickly run through this. So first off, one of the things is that sales and operations planning and all these other processes, if you're a simple manufacturer, the traditional 5-step process is probably working really well for you. But the problem is the more complex you get, and the more that you see the types of things you saw in this case study, the less effective it's becoming. And the same is true for whether it's integrated financial planning or integrated performance management. It doesn't really matter. But what you're finding is that the more complex you get, the more likely you're experiencing these types of things. So scenario planning is not so good. The commercial function is not that effective. Decisions are taking place outside the process. Executives aren't engaged because, it's not really reconciled to financials. And in a lot of cases, when Richard was designing the process in his last company, they couldn't even get the thing done in less than a month. So it was like 6 to 7 weeks before they could actually get through it. And, the same things are happening. These exact same things are happening in the financial processes. And one of the key things here that we need to remember is that in a lot of cases, when you look at S&OP, that inventory decisions are being made independently of cost to serve and overhead cost management. That tends to be problematic because the more complex you get, the more likely it is that inventory is just one of the levers that you got to pull. And that when you think about, commercial functions, the commercial functions should be driving, the profitability of the products and the customers. And what you're finding is that they don't actually really have effective levers to do that. So, when you start getting more complex, one of the things that you need to do is be able to integrate like inventory and overhead cost management, supply chain planning, and cash flow forecasting. You just can't separate these things. These are all highly interconnected. So trying to do it separately, it proves it just doesn't work. So let me just quickly illustrate a couple things. So you may be a company where you're increasing revenue, increasing gross profits, and turnover is going up, but net profit and free cash flow is going down. That's not a good situation to have. So if you're heading an S&OP process, finding something like that or experiencing that is not a good thing. And I spent 10 years doing this type of work where I ran into this exact problem, and I see it happening over and over in a lot of companies. And one of the reasons why this is happening is that you end up, with these unexpected costs. You have all these things that you're doing to support digital efforts, that kind of thing, which are contributing to overhead costs. And it's not just the fact that overhead costs are going up; it's how variable the resource consumption is. And when your companies are pursuing these digital strategies, it's even worse because the variability is getting even higher. So, when I was doing a lot of this profitability management work, this was actually much of it was centered around activity-based costing. And what we'd end up finding is if you actually just, I don't know if you all of you know what activity-based costing is, but if you took a stopwatch, if you will, and got everybody to every 5 minutes to record what products and customers are you working on, and then add it all up, you probably end up finding that whatever you have in your systems are totally incorrect. Much of this really was driven by misallocation of overhead costs. But one of the things is that misallocation of overhead costs is really indicative of other things too. One of which is that if you can't manage overhead costs, you probably don't understand the profitability of your products and customers. You probably don't understand business segment profitability either. This is a huge problem. If you're a global company and you're operating business segments across multiple countries, chances are you don't have an accurate profit and loss statement because you're not projecting costs correctly. So the takeaway here is that the planning models that you're using are just probably incorrect. And the thing is, you're probably not planning outcomes. What you really need is a more accurate process. And this is really where, I see the integration between finance and ops. You've got to get rid of these anomalies because I think that ops people tend to give financial systems and process a little too much credit. 9 times out of 10, their forecasts of overhead costs are not that accurate. What we really need to have is greater accuracy of overhead costs, so that you're not seeing these anomalies where you're not actually forecasting how individual products and customers consume resources. And this is actually borne out in a whole bunch of research studies that companies who undertake cost reduction efforts just can't sustain reductions for more than 3 years. There's 4 studies by like Gartner, McKinsey, Ernst & Young, and this is very consistent with my own personal experience. And really, one of the biggest problems that companies have is that they don't manage expectations all that well. So, because really what we're trying to do is manage, what's the customer want? versus what can we afford to deliver them, or what are the shareholder expectations? Or more specifically, how do you manage operational and financial outcomes? So if you recall, one of the things that, when you first get into S&OP, one of the big things we're trying to do is balance supply and demand, which is, in smaller, in basic terms, is if I increase the service in terms of just providing, investing in more inventory and to give more on-time delivery, how much does that cost in terms of supply chain costs? But that whole concept of balancing trade-offs was, if you look at most when people talk about IBP, it's never thought of being extended to the enterprise as a whole. And the reality is that these trade-offs happen everywhere. So when I see, people talking about IBP, they're really not talking at this level, because this is really, the underlying problem. So if you want to have a mature IBP process, you need to be managing these trade-offs everywhere. And there's just piles of evidence to say, we're just really not managing these things all that well. As you get more complex, you're just managing this across multiple functions, entities, and this whole idea of managing inputs and outputs and managing trade-offs just isn't there. By the way, there's a link down here. There's actually one of the videos I have, really, it'll go into detail and show you each of these individual research studies if you're interested in looking at it. But the thing here is that this is a very costly thing. This is costing companies huge amounts of money. And this is really the opportunity for, integrated planning, is to really address this cost of complexity just by managing these trade-offs. And this is really a simple picture of, what's happening. That, if you think about the models that we're using, like for example, in supply chain, or like where we're doing supplier selection, that type of thing. In a lot of cases, those models are really only looking at maybe 50 to 60% of your cost structure. The reality is that if you want to avoid these consequences, what organizations really need are models of the entire business. You need to understand the economics of the business as a whole, because, like I said, the bigger your company gets, the more likely it is you're going to have these unintended consequences that end up in overhead costs. And what's missing is that people can't see these things coming. They don't have the decision rights to prevent it. They're not motivated or incented to address the problem, and the processes just aren't fast enough to fix it. And again, much of this really centers around, if you think about the tools that are out there, that, the supply chain tools do a really good job here in terms of managing, direct labor and material that may not provide information that's suitable for financials. They may be somewhat capable here, but really little capability here. And the reality is, on the financial side, they're not that good either. So the net is you've got really some major gaps here that are really kind of falling between the cracks of financial and operational tools. And this is a big problem for a lot of companies. I see a major thing. So the reality is that companies don't really have the planning and performance management systems to support the complexity of their business. So that is sort of my take on the current state and kind of where we're at now. So what I'm going to do now is just talk about some critical capabilities that I think are kind of falling. We talked about some that are really kind of falling between the cracks. I'm just going to quickly describe these. And by the way, I have a separate video on my website that, that's like a half hour, an hour, that describes these in more detail. I'm just going to go over these quickly. So there's really four things that I think that problems that companies have. They're still very siloed. Targets are still disconnected from resources. The planning models aren't accurate, and they have fragmented and slow processes. And there's four incremental capabilities I'm going to talk about in terms of how you can fix this. But the net of all this is that when you really think about, most companies really lack formal mechanisms for optimizing enterprise value. And I don't mean like an optimizing tool. I mean like what is the mechanism for how you optimize value and how you get people focused on the right things to drive the right outcomes. And in the end, what's missing is this ability to plan, manage, and govern outcomes and trade-offs. And this is as I mentioned before, this is one of the fundamental problems with being able to establish effective commercial functions, because they're the ones that are really kind of pulling the levers to manage the profitability and the performance of individual segments. So this is just put this in to reinforce this issue, but I did a summary of a bunch of research studies that were done, and the number one problem that came up that was in terms of a barrier to executing strategy was functional silos. And this whole idea of functional silos is not new. We've been talking about this for 30 or 40 years, and we still have not been able to fix it. And one of the things that I believe that companies ought to be doing is kind of thinking about costs and processes this way. So if I went to a company and said, who owns your order to cash process? So who owns perfect order fulfillment, days in receivable, cost per order? So, who's accountable for for managing this? Who has the decision rights to go in and make whatever necessary changes are? And who is it that's driving? So if you've got one segment that you're hitting $10 an order, 25, anyway, the bottom line, you'll find that nobody's accountable in most companies for this. So if you're really trying to drive, a cost structure, or you're trying to drive a service level, and if you can't, self-adjust or have your cost structures and processes self-adjust to these changes, you're probably not going to be terribly successful. And one of the biggest impediments to this, so, having these sorts of information is that this is not a new thing. The problem is that most systems don't reconcile things to finance. And as a finance guy, I know this really well, and you guys probably know it too. If your information doesn't reconcile to the general ledger, its credibility is probably not that good. And you're probably not going to drive too many changes. So if you're trying to tear down functional silos and get people to focus on this rather than functionally driven costs and performance, you're probably not going to be terribly successful. Now, one of the things as well, so as you start being able to manage this way, as I illustrated in that case study with the book publisher, you now have the ability to start understanding where my opportunities are for investment. So I now can have the foundation for having dynamic portfolios because I understand my process performance. And based on that understanding and understanding of how products and customers consume resources, I now can have a portfolio of products and customers. So this is just illustrating that, which products and customers are really my most valuable. And this is what, and by the way, not just at a margin level, at a profitability level, because the thing is, you have to be able to, managing gross profits is important, but it's how you manage the overhead costs that are underlie those products, which is really important. So being able to manage that and give your segment managers and your commercial group the wherewithal to manage, like I said, the trade-offs between service levels and profits. The next thing that companies are really missing is what I would call integrated scenarios, because really what's happening is that we're doing scenario planning in silos. Even if we have an optimizer, optimizers are really only looking at parts of the organization. So what's really missing, I think, in companies is optimization tools that can, and not just kind of traditional optimization tools, but advanced prescriptive analytics that can simultaneously evaluate the implications of decisions on all aspects of the business, not just from a supply chain perspective, but from a financial one as well, because the tools that we're using in operations for optimization are the same ones that the tax guys are probably wanting to have to do tax planning. And, this is just an example of such a tool. So there's tools called evolutionary computation that enable you to do this kind of thing. I'm not going to get into all the detail on it, but just I'm putting it out there to kind of give you an indication that these tools actually do exist, and that they kind of go beyond kind of traditional linear optimization tools. And what underlies a lot of this are what I call flow-based models. Now, as a supply chain person, you may probably be looking at this and saying, well, this is really just a supply model, which it is. So, but this is actually a graphic that I put together when I was working for the prescriptive analytics software company. And one of the things that people don't always recognize is that, these supply models they're really activity planning models. That's really what they are. We ship orders, we store products, distribute products, make products, buy, they're pretty sophisticated ones, but, driver-based planning models nonetheless. Now, the thing here is that, one of the things I put this in front of finance people before, and, their eyes kind of glaze over and they're thinking, well, why the hell do I need to know all this stuff? And, this is kind of like me inserting a piece of insight for the finance people right here, that this sort of, the more complex you get, the more likely it is that you need a model like this, because one of the biggest problems that most finance groups have and companies have is that they can't do cash flow forecasting. It's probably one of the worst processes from a finance perspective. And one of the problems is that you cannot possibly do effective cash flow forecasting without understanding the flow of inventory. It doesn't work. You've seen these, financial planning tools that try to estimate it, not even close to being correct. In a $20 million manufacturer, maybe, but if you're, $2, $3, $4, $5 billion company, the chances of you getting a correct cash flow forecast and doing any sort of effective scenario planning are kind of slim to none. And the reality is that, if you look at, I would say the vast majority of financial planning applications don't even come close to supporting something like this. And the thing is, as well, not only is this important for planning, it's also important for managing internal customer and supplier relationships. So if you're really trying to manage across functions, you need to be able to do this. Plus, you also need to be able to plan across legal entities. This is a big thing for both supply chain and financial folks. And it's this model and be able to plan by activity, which allows you then to plan trade-offs from business process levels up to products to customers. This is really what companies what they really need. And it's this inability to do this. If you cannot do this, you probably cannot effectively manage your business segments. So the numbers you're working with are probably incorrect. So that was a really quick overview of what the key capabilities are that companies require and why they require them. And we'll get into a little bit of detail about how we fix this and embed it into a strategic IBP process. So I'm just going to walk through, a strategic IBP process right now. And the main output here, so I want you to be able to visualize how you connect the traditional 5-step process with a rolling forecast and more integrated process that incorporates these sorts of capabilities. So if you look at a traditional 5-step process, I just took a few graphics off the internet, and all these review points are all kind of basically the same. So you do a product review, demand review, supply review, pre-S&OP, that kind of thing. Now, what's missing, I think, are what I call this functional and process review and market segment review. And I've mapped these are really sort of outcomes, right? So A demand review is a kind of a summary of, I've managed performance, and I've done some forecasting, likewise with supply review. But this is the process that gets you to these review points. So this is really more of a generic process that describes, the integration of finance and operations. And what this functional process review is really what a step I call validating resources, and this is aligning portfolios. So some of the, I told you before when I was going to, when I talked to you about the case, that I was going to show you this slide. This little graphic, remember, if you recall, I told you how simple the process was that this department manager was using. One of the things that those sorts of capabilities are built into this app, and what it's doing is driving this graphic over here. So this planning process that the department manager did for the supply chain department is driving one of these intersection points. And it's that kind of foundational building block that gets you to an integrated process that allows you to plan at a matrix level. Now, I'm just going to reiterate something. This sounds like it might be terribly complicated. This process, as I mentioned before, dramatically reduced the time and effort taken by a lot of the functional leaders because it was driven on those explicit conversations I mentioned. The other thing is under aligning portfolios, your process needs to incorporate all these different overhead costs and really give you a true picture of profitability. That is not something that's being done in a lot of processes. And what it needs to be doing is driving financials as well. So kind of some of the main things that are really different is that, in managing performance, we're really kind of focused on issues, tasks, and performance commentary across these multiple processes. And when we're quantifying resources, we're not just doing it for supply chain. Our models are really kind of connecting across the entire business. We're connecting everything to our financial planning and budgeting process. So in this step here, this is where the big connection is with finance. We're aligning. One of the things we're doing when we're aligning portfolios is this is kind of like what I would call the cost structure engineering step, where you're aligning what your propositions are to the cost structures in your processes. And as well, when we do scenario planning, we're doing scenario planning at an enterprise level, not just at a supply level. And there's a couple points here I'm just going to raise that I think, Richard, when we were working at your last company, this was a major headache for you guys in demand planning, as I recall, because there were, trying to get all the various views of demand and revenue was just not an easy process.
Right. Yeah, I mean, we were making decisions around volumes without seeing the impact of the revenue, right? We had to wait till the next cycle to see the actual impact of those volume decisions on cash flow. And the impacts were often not what we were expecting because of what you talked about with the unintended consequences, right? We really couldn't get past the tactical IBP process. And like you just pointed out, accountability for profitability was never pushed down from below a general manager level, right? The decisions we made left a lot of cash on the table, Dean.
Yep. I find that depending on which tools and processes that you have, a lot of companies are experiencing similar things. I know that some progress is being made kind of integrating certain aspects of these processes, but there's still a lot of holes there. So basically what I just showed you was a process that brought all these things together in one workflow, right? So anyway, I think that just to kind of give you an idea of, we'll get into a discussion on, how you make this happen, the technology, the group types of technologies that enable this in a little bit, but suffice it to say that this is not pie in the sky stuff. This is really doable things. So I'm going to turn it over to Richard here for a discussion on how you integrated planning with advanced production and scheduling.
Okay, thanks, Steve.
First off, we're going to start on, so we're just starting off with this initial process first. We'll show you how it integrates.
Okay. Yeah. So earlier I mentioned that the 5-step process Dean's got here isn't a complete process, right? It's these other steps that he added in: to validate resources, align portfolios, scenarios, and optimize. Right. So go on to the next slide, Dean. Two key points of integration here, right? And it's all around quantifying and validating our resources and the advanced supply plan, right? I've got to implement forecasting capabilities that I got to implement analytical forecasting capabilities that give me probability, right? 90% confidence intervals that for our foundational businesses, our core businesses, sales will be in this area as long as we continue to do what we've done in the past. I've got to treat that differently in the forecasting process for new stuff coming on, right? Stuff in our funnel, our opportunity funnel. There's different confidence in achieving those, and I've got to share that confidence into our advanced planning system. So if I start loading my assets, I want to load my assets to ensure that I can optimally deliver core foundational business. I want to plan my assets so I provide flexibility for the stuff that I don't have that good of confidence in, right? And I need to combine my collaborative forecasting process with the rough cut forecasting process, and we got to start talking about probabilities. We got to start talking about a base case. We got to start talking about, well, what happens if a best case happens? What happens if a worst case happens? What are critical decision points, and what are leading indicators around that, right? How do we build out mitigation strategies? I'll go on to the next slide. Talk a little bit, the forecast again, it's probability distribution, right? We're going to look at in my past and into the ERP systems, it's always been a point forecast. We feed that one number. Well, reality comes in, and that one, we're always chasing. Well, wait a minute, we didn't hit. We said 100, we only sold 80, or we sold 120, and we start jumping through hoops trying to explain why that happened. Well, in reality, with a probability distribution, the discussion becomes, we're going to sell between 80 and 120, and that's okay. We expect that. That's natural, inherent variability out in the marketplace. What we want to really do is start managing by exception when we sell outside of that probability, when things are happening outside of the probability bands, that's the exceptions that we want to start building mitigation strategies for. I'm going to go on to the next slide, Dee. Safety stock is, a lot of people calculate the safety stock just based on demand variability, but safety stock really depends on my lead time too, right? Different strategies around how I deliver to the customer, right? Multi-echelon kind of inventory planning stuff. My demand where I forecast my demand needs to be paired up to how I'm supplying the customer. In these tools, I want to be able to do that. I want to be able to set I want to right size my inventory based on, look, what is my distribution channel? Is my distribution channel e-commerce? Is it through a distribution warehouse? Is it direct to customer? These are different options, same product, same set of customers, but customers have different ways to purchase. I need to be able to reflect those different ways of purchasing in how I size my inventory. Okay. As orders come in, I need to be able to confirm these orders, right? I need to be able to, as an order comes, is it a forecasted order? Is it an unforecasted order? If it's an unforecasted order, what are my opportunities to deliver that, right? And I want to treat them differently. If it's a forecasted order, I want to be able to guarantee short lead times. If it's an unforecasted order, I want to be able to go back with scenarios to my customers to say, well, we can't deliver optimally, but here are the choices around how we can serve you. Next slide, Dean. New products is a good one, right? New products is in my past, a lot of systems, I could not plan capacity for a new product until I had that new product 100% defined, right? All the way down to this is the line I'm going to produce it on. This is the raw materials. Well, new products as we develop them, we may not know that, right? As we're developing these products, things change. Bill of material, recipes change. Even the customer base can change. I need to be able to do new product introduction in a phased approach. It's I call it a critical path for supply chain and a risk matrix kind of thing. It says at some point I want to make sure that I have capacity available if I'm going to develop this new product. I don't want to spend a lot of time developing a new product and then realize that, well, wait a minute, I don't have an asset to make that new product on. Also, I want to it's called design for manufacturability, right? I want to feed back to from my supply chain into my new product development. I want to say, look, we want to design for manufacture. We want to optimally use our assets, and in order to optimally use our assets, here's how we need you to direct the product funnel, how you're developing new products in the future. Next slide, Dean. Constrained demand and unconstrained demand, right? One of the key things we ask, we want to know what we could sell, right? Because we want to know what our potential market is. In my past, we've always told our sellers, the sellers are the voice of the customer into our IBP process. We need you to tell us what the customer needs are. Where we've fallen short with prior IBP processes, well, that's just half of what a seller has to do. The seller also has to represent the company to the customer. We have to represent what we're capable of doing to that customer, right? I always run into where a seller's out there and he's doing an unconstrained forecast. As he's doing that unconstrained forecast, he's making deals with a customer. It comes around that we get into a position we can't deliver. Well, the customer gets disappointed. The sales guy loses credibility. Our IBP process and our advanced planning solution needs to be able to do both. Yes, we want to capture what true market potential is, but we want to go back and be able to build deals with the customers that reflect what we are truly capable of doing. I'm going to the next slide, Dean. This is all bi-directional, right? It's we talked about the 5-step process, and one of the, everybody draws out the IBP 5-step process as it's linear. It's really a circle. It's the output of one planning process becomes the input of the next cycle's planning purpose. With linear, this is what takes us a full month to get through a planning cycle. With these advanced planning solutions, the advanced scheduling solutions, we want to collapse that timeline, right? It's, well, why can't I replan? Why in a month? Why can't I replan in 2 weeks? Why can't I use demand sensing, supply sensing through an advanced schedule that every week I have like a scrum meeting that says, look, here's what we said we were going to do. Here's what actually happened. What's the impact on the plans for that? How do I replan, right? The whole goal is, instead of waiting a month in this linear process, why can't I replan a lot faster? Okay, Dean may have to help me with this slide a little bit, but here's how, through there, we're going to get through it, right? These, if I can build it out into one model, right? You guys have probably heard about the digital twin, the digital supply chain twin, right? If I can model the flow of materials through each stage of my supply chain, all the way from raw materials to customer delivery, I can build that into a single logical model. I can reflect all of my trade-off decisions I have to make around capacity, around if I want to serve this customer better than this customer, what's my impact on inventory? Right. One of the limitations to that right now, and I can use an example of current software I tried to implement at another company. Well, the software we tried to implement to do this it's actually three modules, three separate standalone modules, all sharing their own data bases, their own data models for each of them. Well, connecting those was difficult, right? There's all kind of middleware trying to pass data from one tool to another tool. So, well, why can't I get to a single logical model that can do all this? One single logical model that I can support with one single data model, right? I shouldn't have to have three versions of demand, or multiple versions of supply. I should have one version that end to end I'm managing. Want to go on to the next slide, Dean?
Yeah, well, I just jumped in on that one just to share some thoughts as well, because I think if you look at this evolution, and this is really where, if you look at what you just described, were, kind of the traditional approach, because a lot of tools, have, separate logical models and data models. I mean, I think some of the newer tools that you're seeing on the market today, they may have, single data models, but what they're lacking is the logical model. And this is really where I see kind of like the real innovation that's driving a lot of the things that we've been talking about. And, like I say, you're not going to find these, on, the mainstream systems. These are kind of newer technologies that are doing some pretty breakthrough things. And the thing is that the reality is that the main point here is that these things are not kind of the pie in the sky stuff anymore, that these tools actually exist and that they actually form the basis to do a lot of the stuff that we've been talking about. So this is the thing that this is the graphic that kind of got me, that it's this kind of moving away from, having just a single data model to having a logical model, which is driving a lot of the innovations.
It's good. That's a good explanation for me, right? Yeah, and an example, like, we've struggled to build this in ERP systems because the ERP systems are not really master data model systems. They're not really data management tools, right? I'm using transactional data, and I'm trying to manipulate that transactional data into some kind of planning data. Well, that transactional data is changing all the time, right? I don't deal with average run rates, things like that within my ERP system, right? So it's difficult to build that out.
Yeah, you can. Thing is that, if you look at a lot of the tools, I think that even though they're being called integrated, what's really happening is you're building plans and kind of throwing them over the fence to somebody else to figure out. And that what's not being recognized is that the trade-offs that you're dealing with are just terribly dynamic. And what you want to be able to do is pass them back and forth between, your advanced production scheduling and planning to your integrated business planning, because you always want something that's kind of rooted in reality. We could spend 2 hours talking about this stuff, but I think the main takeaway here is that, what we've been thinking about is integrated planning has come a long way to what, you might find in kind of traditional discussions about what integrated planning and scheduling is. And I'm just going to do a quick segue into some discussions on finance. We're a little behind here, so I'm going to pick up a little time on this and run through this part on finance. So for some of you, you may want to give this video to your finance colleagues, and kind of there's really kind of 5 things that you may want to tell them, that mature forms of operational and financial operational integration that we've been talking here really do all the things that we've talked about, that I show here on the screen, not the least of which is increasing the productivity of finance and reducing costs. So there's some real immediate benefits for finance for doing this. I'm just going to walk through what those things are. So whenever I talk to kind of a finance guy about a rolling forecast, and I think, a lot of people are thinking about, that there should be a lot more synergies between a rolling forecast and sales and operations planning. to me, this is what the resulting process really looks like. I mean, if I'm a finance guy, I'm thinking, gee, I'd love to have a process where strategies and cost structures self-correct. Yeah, to have accurate cash flow, that would be amazing. Because I really can't do cash flow forecasting right now, and I know that cash flow forecasting is really sort of a leading indicator of how effective your planning processes are, because it's based on resource consumption. And as well, I'd love to be able to have a scenario planning process that look at both finance and ops, while incorporating a lot of these kind of traditional financial planning operational planning methods. So one of the things that I think that people need to understand is that when you look at the maturity model for a process as a whole, it actually look a little different, because right now maturity models are just segmented. And this maturity model here, you see there's kind of two sides to it. And I'm going to go over this quickly. I have like an hour video on my site if you really want to look at it. But basically, in the bottom here, that processes and tools are still predominantly functionally focused. And at the top here, they're really kind of driven by processes and trade-offs. And the reality is that if you look at companies like Gartner, if you look at companies in their top segment, their leadership segment, they're still not providing mature processes. I know that Richard knows this for sure, because in his last company, they were using two tools that were in Gartner's top Magic Quadrant, but had probably some of the worst processes known to mankind. I don't think I'm over exaggerating on that one, am I, Richard?
You're not. It's a painful history. No, but yeah. You're not.
And I think that the way that Gartner, their role is to just look at types of software tools, and these categories have been around for a while. But I think this categorization is terribly misleading, and especially as well. Like Gartner is not looking at manufacturing specifically, but when you look at manufacturing, it looks a little different. So if I'm well, first of all, most companies are here. So if I'm going to get to a stage 3, what does that look like? So here's some of the things I showed you before. Like if you're at stage 3, you got to be able to plan and manage from both a functional and a process perspective. You've got to be able to use kind of the planning models that we talked about to support, this type of view from both a process and a functional perspective. But you also need to use those planning models to drive, really sophisticated scenario planning that leverages, some more advanced prescriptive analytics. And you should be able to do these integrated scenarios from multiple perspectives. You should as well be able to drive the sort of integration that Richard was talking about. This is, to me, what which is indicative of more of an outcome-driven process. And as well, you should be able to drive your processes and look at segments of the business, and the customer-related outcomes and profitability across multiple legal entities. And you should be able to use that to drive optimized value. And then you should be able to, when you get to really a real mature stage, you should really have a dynamic view of the value of your product and customer portfolios, and you should really be hitting on all cylinders. Now, this view of the marketplace is terribly different than what I see in the marketplace today. And one of the things is that I think that the way that we're thinking about processes is a tad different, because I think that, by the way, that what this slide is doing is there's a half-hour video that describes what a mature rolling forecast and integrated sales and operations planning process would actually look like, sort of like from a layman's perspective. And this is really indicative of what I call a really mature process. So, for example, like a couple things which are easy to point out. So if I'm a finance guy, I should never have to do another manual variance analysis ever again. You know, volume, mix, price, productivity variances ought to just fall out of the system. And the thing is, you will not find that capability in any financial software system. It doesn't exist. As well, like if you're a finance guy, you know, the system ought to be developing the models for you. You know, I think that, you know, finance and ops ought to be sharing a single planning model. So this is just kind of an idea of some of the things I see that are you're actually capable of doing today that are not reflective in these, traditional maturity models. And, you know, from a more practical perspective, I think, you know, by looking at these processes more holistically, if you look at the amount of redundant activities that are going on, it's insane what's going on in a lot of these processes. And, you know, Richard, when you were doing this at your last company, it was just painful how bad these processes really were. And again, these processes were supposedly being supported by leading technologies, right?
Yeah, that's right, Dean.
Yeah. So anyway, I'm not going to go into a lot of details on, but these are the types of things that, you know, just from a real practical perspective, that finance functions should be looking for. Now, this is really different than, you know, what you'll find in a lot of things that you'll see being published. I think I'll tell you, like, this is something I saw from, I don't know if you know who the Hackett Group is, but I looked at, when I read what they were saying were kind of leading practices and what I view as being leading practices, to me, they're just entirely different. You know, I just don't see, if you look at, especially when a lot of their focus is on financial technology. I mean, if you look at the financial technologies out there for global manufacturers, I'd be hard pressed to say that any of these tools are really supporting really kind of forward-looking processes. Obviously there are some that are more advanced than others, but, you know, as a rule, I think that, you know, companies who are talking about these tools as being kind of things that are really going to transform finance functions, I think is a bit of a stretch. So, you know, that's some of the things that you can help out with your finance functions, because one of the things I found that, you know, a number of finance people are kind of finding this out the hard way, that these tools are not delivering the types of things that people think. So these are some of the key messages and things that you can kind of take your finance guys, so that, you know, there's some insights here that'll help you to talk to them about how you guys might work better together to achieve mutual benefits. So we're probably like 10 minutes behind schedule here. I'm just going to quickly run through a couple things on technology, just to kind of wrap it up. So first off, some of the things I've told you about in terms of capability gaps in existing solutions, I don't think means that you should replace them. I think that there are other opportunities, and that, in fact, that's one of the things that Richard and I were looking at his last company, was how do you augment what you've got? And one of the things that is really kind of driving this augmentation strategy, and this is one thing that, if you've never heard this before, this is a really big deal, something called low-code application development platforms. You know, I just took these things off the internet. This is a huge deal. Probably Gartner calls, I think it's one of the 3 megatrends or whatever, but massive reductions and changes in increasing capabilities for putting processes together. So what I see these tools doing is dramatic improvements in process maturity, drastic reduction in development costs. So if you look at some of these older technologies, let's say that, you know, pick an S&OP or a financial planning tool, and, you know, if they spent 100,000 hours developing this tool, and if it's an older one, you might be able to replicate that same thing in, well, in just massive reductions. So what that means is that, I mean, a lot of the investments that these older tools have in sort of their process infrastructure are just totally out of date. So, I mean, these low-code tools, I mean, most people think of them as process execution tools. These things have immense opportunities in management process execution. And so these are basically the components. Again, we could spend an hour or two just talking about what these tools do, but basically what these things allow you to do is develop application in a fraction of the time. But so what that means is that you can customize solutions, you can develop processes are just way faster than you could have previously. And if you do a Google search on this, you'll find millions of things and piles of things that'll validate what I just told you. You know, one of the things that these tools do a lot much richer issue management and collaboration capabilities are key outputs of these tools. And as well, again, I'm not going to spend a pile of time on this, but one of the things that you know, Richard and I were talking about was the use of these tools to do kind of some of the front end stuff. So for example, using a low-code tool to do a product development process that goes end to end from, you know, requirements through to multiple versions of your bills of materials that use the same planning model to help you quantify, like if I develop this product, what's it going to do to my sales, cash flow, profitability, you know, all that stuff in one tool. And then once you've figured out that you want to operationalize the tool, take it and dump it into your ERP system. So not only does it become like an integrated development tool, it becomes a master data management component. So you can do the same thing with your customers and contacts, suppliers as well. It can actually become part of the front end to your order promising. So as you know that your ERP systems really are not that great at doing things like order promising. You know, they don't really have the integration with you know, the ERP systems or the scheduling systems. So the reality is that these low-code platforms can dramatically change how you think about implementing both ERP and integrating APS systems. So they're just massive opportunities for improving these processes. And, you know, going back to what Richard had talked about before, you know, just drastic reductions in both, you know, the total cost and implementation time, while collapsing or providing greater value. I'm just going to quickly run through these ones and kind of get over to Richard. You had some parting thoughts that you wanted to share with some of the operational folks on the line here.
Oh, yeah. Thoughts about where, you know, Dean had asked me recommendations on what I would tell a new supply chain professional coming in, right? And I put down three things here, right? I don't know if you guys, I used to hate when throughout my career, I've got my annual review and everybody would ask me, what do you want to be in 5 years, right? And every time I gave an answer, well, 5 years later, whatever job I said I wanted no longer existed, right? Everything changes. Everything's changing very rapidly out there, right? So I'd say, well, look, if I was going to give advice, it's get educated, right? There's a lot of misinformation in the market out there. A lot of vaporware. Get educated on what the art of possible is out there, right? Think holistically. Don't silo management, right? Don't focus just on the supply side. Don't focus just on the commercial or the financial. Think holistically across all of those. And the biggest one I really go, and I try and drive this with the team I'm building right now, is think like a business owner, right? The CEOs and the CFOs don't want to have to make every single little decision. If you can act like a business owner, it's your checkbook that you're balancing. What decisions would you make as a business owner to optimize value to the company? That's all I had, Dean.
Thanks. So that's basically the presentation. I'm just going to quickly run over a couple of things. So we started off with these questions. I hope that we covered them off. I'm certain that we did. We started off with these objectives about, you know, telling you what we think a fully integrated process is and what challenges they address and what they could be worth. Now, as well, I'm not going to spend a pile of time on this, but one of the things that we're doing I've talked to Timo a little bit about this, and we're trying to do a research study that looks at, integrated planning from a slightly different perspective, really focusing on the intersection between finance and operations. And the thought being was that through this research study, there may be some opportunity to help you guys assess maturity levels, identify your gaps, and assess benefits. And if you're at all interested, please reach out and we can talk further, but I just wanted to make you aware of that opportunity. So with that is it. We're 10 minutes over, apologies, but I think we're at a point where we can open it up for questions.
Thank you, Dean and Richard. Excellent presentation and a lot of good points. We do have a couple of questions in the chat, and maybe you guys can start from the first one. Juhani Vuola is asking about activity-based costing. What is the difference in IBP if in both cases the supply chain finance controller understand the overhead driver? Same question other way around. What is the best alternative for